Hi everyone. In this video I want to go through another straight line depreciation scenario, and I've already done one video, a scenario 1, and in that scenario I was acquiring an asset, depreciating it, and disposing of it without any salvage value. In this scenario what I'll be doing is acquiring an asset, depreciating it, but I will have a salvage value and then I will dispose of it. In this scenario, the other thing that I've done is I've used the same numbers basically from the first scenario with some slight changes. And in this one, I've highlighted the fact that I'm going to have a salvage value of $2,000. All the rest of the scenario is exactly the same as the scenario 1 video that I did. So to start out with, when I actually acquire this asset, the journal entry is the same as before. When I acquire it, I will be debiting machinery and crediting accounts payable. However, now I need to calculate the value that I'm going to depreciate over time, and in this case I take the purchase price minus the salvage value to get $118,000. And so therefore I'm going to depreciate the 118, not the 120. So when I take $118,000 and divide it by 10, my annual depreciation that I will need to recognize on the books is $11,800. In the first scenario video, this amount was $12,000. So you can see how you can compare the two situations if you look at both videos. So our first journal entry for depreciation will be a debit to depreciation expense and a credit to accumulated depreciation for that piece of machinery. You can see the T accounts have the values over there on the right hand side. Then each year after that I will recognize $11,800 worth of depreciation expense every year and put that also into the accumulated depreciation. So at the end of 10 years, basically what we have is we've got a piece of machinery that's sitting on the books for $120,000. Its associated accumulated depreciation account has $118,000 in it. So when we look at the book value of what this asset actually is valued at the end of 10 years, it will be $2,000 because $120,000 is sitting in the asset account, $118,000 is sitting in its associated accumulation. We will carry that salvage value for as long as we own this asset. However, after this point in time, we're going to dispose of it. So let's see how we get rid of it now. So the journal entry in 2012, if we decide to get rid of this piece of machinery, and if we decide, in 2012, if we decide to get rid of this and get it off the books, what we will do is we will debit accumulated depreciation. Our accumulated depreciation has in it, for this piece of machinery, $118,000. So that's what we will debit. We will credit machinery, which has $120,000 in it. If we just did that journal entry, we would be out of balance. Journal entries have to balance, so we've got an extra debit of $2,000 that we need to account for. And what that is going to be is called loss on disposal, because in this situation we've gotten no cash for it. Maybe we've taken it to the dump, maybe we've donated it to somebody. Disposing of it just means that we've gotten rid of it, we no longer own it, we've given it away, trashed it, whatever, and we have gotten nothing in return. So that $2,000 difference, that salvage value, becomes a loss on the disposal of this piece of equipment. If you have any questions whatsoever, please leave them down below in the comments section. I would be happy to answer any questions you have about this scenario. I will have more scenarios around straight line depreciation and other methods of depreciation coming up soon. So I hope to see you then, and thanks very much for watching this video.